functionality is powerful, but how does the conversion really occur? Who are the participants? Where does the capital come from? And are there things that can make and improve liquidity within the ecosystem? I'm excited to hear the insights from our guests, and I will now hand it over to SDF's very own Phil Meng. Phil, the floor is yours.
Thank you, Lisa, and hello, Meridian. Welcome to the Liquidity, Exchanges, and Conversion panel. I'm Phil Meng. I head up liquidity strategy at SDF. I have a background in equity derivatives trading and market making, starting from the physical exchanges of the American Stock Exchange and then electronic desks at proprietary desks. As Lisa mentioned, Stellar has a decentralized exchange, or DEX, built within its protocol. Any Stellar asset can, in theory, be exchanged for any other Stellar asset on the exchange, as long as there's liquidity in each of those assets. So liquidity is essential for an exchange to occur. This means there needs to be someone, someone's, or something on the other side of any conversion. This often requires the need for market makers, liquidity providers, or other market participants. Enabling and growing liquidity is a challenge for any new asset or new venue, and I'm excited to have a wonderful panel to share their experiences and talk about how they think about liquidity, exchanges, and asset conversion. First, we have Catherine Coley. She's the CEO of cryptocurrency exchange Binance US. That's the US arm of Binance.com. She comes from a background of FX sales and trading at bulge bracket banks and spent some time in Hong Kong and London. We also have Scott Freeman. He's the co-founder of JST Capital. They are a crypto trading firm providing execution, trading, and advisory services. He also has an extensive background from the traditional FX trading world at large banks. And finally, we have Theo Ganella. He's a product manager at 0x. 0x is an open protocol for peer-to-peer exchange of tokenized assets whose mission is to help tokenized value flow freely. He has a more technical background from the engineering and product development side. So I think having perspectives from the exchange side, the liquidity provider side, and the technical side will offer some interesting and contrasting perspectives. So I'd love to just start off with where liquidity comes from. And this question is for Catherine. Can you talk a little bit about the importance of having liquidity and, broadly speaking, where liquidity comes from? And using Binance US as a proxy when it first launched, how did you guys attract liquidity to the exchange?
Absolutely. Thanks, Phil. So Binance US is actually an independent entity and therefore had to build its liquidity from scratch. We don't share our order books with Binance, but we do license the technology for the matching engine and allowing us to deliver the best of class technology to American users through a regulated platform. So when we were building out the platform, we had to build liquidity from the ground up. What does that mean? Well, a lot of it, you have to remember, comes back to the people that are needing the liquidity. And so it's back to your simple, bring out the whiteboard, supply and demand of building a market from the ground up. So knowing those in the market that were going to be happy to be both makers, and then those in the market that were going to be demanding it, or the takers, you have to have a kind of a constant balance between those participants in the market and build tools and products for them that they're eager and excited about. And so that's really how we began building it. So first step was knowing a lot of the key folks in the space and getting them on board on our platform, signing them up, going through the corporate onboarding process with some of our key institutional partners. We've got great relationships with market makers from both my past at Morgan Stanley and knowing several of them while working through Ripple. And so it was really exciting to be able to lean on those that were looking to build out liquidity on a new marketplace. Oftentimes that allows for different price discovery that can either allow them to engage in arbitrage or being able to facilitate markets, which is a beneficial strategy for many of those players. So on top of that, we had to make sure that we have depth in our order books to facilitate customers and retail investors looking to buy and sell digital assets on an order book form. So that's really where liquidity begins. It's with the people.
Great, that makes sense. And I kind of would love to contrast that from decentralized exchange, given that Stellar has a DEX and we've seen some challenges in growing that liquidity. So Theo, from ZeroX's perspective, can you talk a little bit about decentralized exchanges and some of the different challenges that you guys have faced in terms of growing liquidity and how you've thought about improving liquidity at Zero X?
Yeah, thanks for having me today, by the way, and hi everyone. Well, there are a lot of similarities with what Catherine mentioned. Obviously, when you start from scratch, this is really the art and science of two-sided marketplaces. You need to start from one side, but then one side wants the other one, and so it's always a balancing act. And yes, to piggyback on what Catherine said, it's really about the people. So even on our side, we had to start from particularly innovative firms that were interested in the crypto space, and also were looking with interest at the decentralized space, which has a lot of challenges. And yeah, so we nurtured those relationships. We basically illustrated the opportunity on the decentralized exchange side, and those relationships have grown over the years, and now we are onboarding more and more professional market makers in the platform. Decentralized exchanges pose a lot of challenges versus the centralized exchanges world, and the main difference comes with the fact that basically the execution of the trade there's less control over it. That's really the underlying difference. In a public blockchain, basically you request to execute a trade, but you don't know when it's going to happen, and it depends on the market conditions. Whereas in a centralized exchange, it's basically a serialized machine that executes all the orders in order, basically, and has more control. This results in a lot of challenges on the user side. If you have ever used a decentralized exchange, you submit the request, and then you're there like waiting. And also on the liquidity provider side, because you don't want to be mispriced. And usually the exchange, which sits in the middle, tries to remove those uncertainties as much as possible. And that's if you want, the innovation on the technology side. And what we've been doing in ZeroX concretely is we started from an open order book model, which is a very, if you want, relaxed model where we leave it to the UIs to figure out the matching, which gives a lot of burden on the UIs too. But we've been innovating on that space, introducing other models like RFQ, which brings more certitude, if you want, on the liquidity provider side, and therefore better pricing on the other side. Decentralized exchanges, though, obviously have other interesting advantages versus centralized exchanges when it comes to liquidity. It can be aggregated, for example. That's all this concept about composability. They never stop running. That's kind of the mantra around decentralized exchanges. And also they offer other interesting models of participation in bootstrapping liquidity. AMMs, automated market makers, are the best example of that.
Great. So I do want to come back to kind of the AMM model, but I kind of want to go to Scott real quick, because Scott, presumably you are the people that both Catherine and Theo are talking about as the participants of providing liquidity on exchanges. So can you talk a little bit about like the major considerations for where you decide to provide liquidity, and also where you decide to consume liquidity?
Cool. Hey, thanks, Phil, for having me. I appreciate the opportunity to talk and spend some time with you guys. Yeah, so having a background in traditional finance, in many respects, trading here in the crypto world is much more complex. So in traditional finance, you generally have a credit relationship and trade on one or two exchanges. Price discovery is pretty clean. Your technology is pretty clean. In the crypto world, there are many more variables you need to think about, right? You need to think about price. What is our asset cost? Where can you buy it and sell it? You need to think about how deep the market is. How much can you trade at that price? You need to think about the technology. Every exchange is different. Every exchange has different technology. They're either located in a different jurisdiction, or the technology is better or worse. Technology generally has gotten much better over the last 6 months to 9 months, but there still have challenges across many exchanges. On top of that, you have questions around jurisdiction and regulation and credit, right? So you need to understand where the exchange is located that you're trading with. Is the exchange regulated? Is the exchange not regulated? What's your credit exposure, right? Because you may have assets at 10, 15, 20 different exchanges in 10 different jurisdictions. So you need to have good legal counsel. You need to understand the issues that may be involved with any of those jurisdictions, and just be prepared. I mean, there have been exchanges more recently that have shut down withdrawals, right? There have been exchanges that have gone dark for a few days. So you need to you just need to understand the risks involved with trading in all those jurisdictions. So even though you may get the best price somewhere, you may not want to trade there, or you may want to limit your trading there if you're concerned about the credit or the regulatory risk in a jurisdiction. With exchanges, what we find is very important as well is just support, right? Things go wrong. There are issues sometimes. You can't get assets out, a trade fails, a message gets lost. Things happen, right? And it's great to be able to pick up the phone and have someone on the other side of the phone answer questions, chase an issue, help you out with a problem. So it's been very interesting for us over the years. We've been in crypto for 6 or 7 years at this point, seeing how things have evolved, and seeing in some respects, it's gotten better than traditional markets, but in many respects, it's just it's a much more complex calculus you have to go through when you decide where to trade and how to trade. And then if you get to the DEX space, all those issues still exist on some level. You need, not only that, you need to understand the technology, right? And some of the DEXs, there've been some technology issues where people have, found pretty impressive arbitrage opportunities and taken advantage of protocol issues in the technology. You need to understand that as well. You need to understand how the order book works. If there are AMMs there, you need to understand how the AMMs work. So it's a very, the longer I'm in this space, the more I keep on thinking it's going to become more and more centralized and more consistent across all the different platforms. But I think what we have found, what we've been surprised about, it's becoming more and more fragmented and decentralized. So even at the exchange level, there continues to be lots of fragmentation. And now that with the increasing number of decentralized protocols, that's just leading to even more increased decentralization across the whole ecosystem. So we've been fascinated by that, and makes our job a little more challenging when we're trading for ourselves or trading for our clients.
And when you mention, with a centralized exchange, you could pick up the phone and call someone. Do you think that's going to be a major hurdle for decentralized exchanges? Because in a decentralized exchange, there's no one to call.
Yeah, I think it is a challenge, Phil, but I think what will end up happening is that they'll hire people to do this trading for them, right? So they'll say, hey, I want to trade on a decentralized exchange. Let me hire a broker. Let me hire someone who has expertise to manage those issues, who can deal with those problems. Problems will come up. We trade on decentralized exchanges every day, right? And we've gotten better at it. But there are still either daily or weekly where issues come up where you're just, orders get hung, trades don't get completed. It's an ongoing challenge. I mean, I've been in this space long enough that when we started trading, one of the exchanges for error messages used to send us back smiley faces. Now we don't get that anymore. That was kind of fun when it happened. It was kind of funny. It was it wasn't a fixed message. It was just a message came back from the API. So we're not at that level anymore. But things still come up, and it's as long as you've been in electronic trading, systematic trading, we're always kept on our toes. Put it that way.
That makes sense. And I kind of want to stick on this thread, Catherine, and direct this question to Catherine. Do you see the growth in decentralized exchanges complementary to centralized exchanges, or do you think they're more a competitive force?
I'm absolutely complimentary. We're way too early right now to start having sharks and jets in terms of what we're building. For our benefit, we provide really a regulated on-ramp into anything digital. So that's really allowing us to convert your hard dollars into digital assets. Where you take those digital assets from there is really up to you. And we provide both the off-ramps There are some great on-ramps in crypto that still keep you inside of their system, but we certainly allow you to take your funds and allow you to keep your coins and move them where you please. So where we become a great on-ramp, we've got selection of DeFi coins that we already have available on the platform that lets you move a little bit quicker into those other projects in the DeFi space. So whether it's DAI, Maker, even Uniswap, we've got on our platform that really allow people then to just be able to make that conversion into dollars or out of dollars easily, because DeFi still is still pretty crypto to crypto.
Makes sense. So Theo, I kind of want to go back to you and talk about AMMs and the explosive growth of DeFi over the past 6 months. So for people that aren't familiar with what an AMM is, can you just give a quick explanation of what an AMM is and how you guys think AMMs stack up and compare against an order book? And I'm not going to ask you to make a reference to a musical as Catherine did so brilliantly.
Well, yeah, I won't do that either, but I want to also kind of also stress the fact that, yes, I absolutely think that they are complementary, to go back to the previous question. And actually, a lot of the liquidity providers that they provide liquidity on the RFQ system that I mentioned earlier, they do cross-hedge on centralized exchanges. So in a way, centralized and decentralized world from a liquidity perspective are already kind of connected, and they need each other. So there is that aspect too. So absolutely, the more we grow the pie, the better off. It's not a zero-sum game, basically. So absolutely. From the AMM side, yes, AMMs have been kind of the surprise of, not really the surprise of the year, but yeah, their growth has been like tremendous. Right now, the decentralized exchange space on Ethereum, thanks to the Uniswaps and all the other models, sees volume in a week that was seen in a year, in the entire 2019. So it's pretty crazy, the explosion in terms of volume. And I think the biggest benefit that these AMM models are bringing is the fact that they solve the one side of the marketplace we mentioned earlier. Basically, they allow to crowdsource liquidity. So anyone that basically has some assets available, they can just show up with their assets, deposit them into a contract, and instantly they are earning fees, but they also are liquidity providers. That's in a nutshell the model that has allowed the Uniswaps and all the other AMMs to solve one side of the marketplace, and instantly all these pairs are available. And the trick around the A letter in the AMM, which is automatic market maker, is the fact that there's always someone on the other side of the trade. So that's what makes it so powerful and creates flywheels that allows, again, to bootstrap markets and have instantly available these markets to users. They do suffer from some problems. I don't think we need to go into those, but they're around, capital efficiency, basically, from a liquidity provider perspective. And that's really, if you want, the advantage of the order book model. So AMMs versus order book. From a user perspective, really there shouldn't be any difference, meaning a trader comes and just wants a good price and good depth in the book. But from a liquidity perspective, from a liquidity provider perspective, what really the institution wants is an efficient way to allocating capital, and order book allows for that more than an AMM. And that comes from a fidelity standpoint. Meaning an order book can represent an AMM, but an AMM cannot represent an order book. It's kind of a bit of a technical way of seeing things, but this allows for operators like Scott's companies and others to be a little bit more agile on how they move their liquidity and how they make money. Whereas with AMMs, you need to deposit it there, and you're not really getting the biggest buck for a penny. And but the cons, obviously, on the order book models, on decentralized exchanges especially, is the matching of the liquidity. And what I mentioned earlier around AMMs, there's always someone on the other side, which is the contract itself, the machine itself will fill the trade, will be on the other side. but on the order book models, you need two sides available, and the matching of that is a little bit more complicated, and that's really what firms like 0x Labs are really investing in terms of making this exchange more efficient.
Okay, great. I kind of want to open this next question up to both Scott and Catherine. Given both your experiences on large FX desks, how do you see liquidity and risk management scaling in either, just in crypto in general?
Catherine, you want to go first?
Sure, I'll talk about a couple of advancements we've seen since I got into crypto, and then would love to know, Scott, how actually useful they are. So we've seen just a build out in the ability for different software layers to help those market makers navigate across different vendors or centralized exchanges or decentralized platforms. And that's really benefited a lot of these market makers because the manual process of removing coins from one platform and putting them onto another, or having pooled capital on both of them, really take out the benefit of digital assets and put you back in that kind of old banking problems where prime brokers were the solution for that. So I think some of the advancements we've seen from a fiat side into the crypto is the SEN Silvergate network, which we've launched for our institutional customers, allowing them to move dollars very quickly in and out of platforms 24/7. And then on the crypto side, and additionally going forward, is Fireblocks, which just recently raised a large round and are continuing to help aid the ability for folks to be able to move funds quickly between vendors. And we see this kind of function being built out more as part of the infrastructure that is required to help markets become more efficient. So I'm excited to see those processes kind of be built out and help people navigate multiple venues a little bit better. But I'd love to hear from Scott's side if he's actually using them, or his own own strategies are good enough, and they're not looking for that diversity of venues.
Yeah, I think we use some of them, Catherine. At the end of the day, we're big enough and think we're technically proficient enough to manage some of these things ourselves without having to go to a vendor. I think some of the interesting things that we're seeing in this space, I think for our clients who come to us and say, hey, earn return on our assets, help us access the ecosystem, return is everything, right? So I think the interesting thing about this ecosystem is that you get returns on your assets, whether it's in DeFi, on exchanges, trading swaps, things like that. I think that's a nice evolution of the marketplace where it's easier for people to identify how you get returns on your assets and monetize assets. We think over time that will be a theme that continues to play out, where people will say, if you want me to leave my assets on your exchange or in your DeFi protocol, what am I going to earn for keeping assets there? There must be some value attached to it. There's value to the exchange, there's value to the DeFi protocol. So being able to share in that value at a client level, I think is very important. We're seeing that already, and we think that will continue to grow next year. We think the use of stable coins will continue to grow. We've been saying that for years. There's been a nice evolution. Stellar in particular has made some great growth in that area. We think next year that will continue to evolve and grow. We think the DeFi protocols like Stellar are great for payments, moving monies instantaneously very quickly. And we think that there will be continued growth and evolution in the whole stablecoin space. And then on top of that, then you'll be able to earn interest on your stable coins, just like you'd earn interest by putting money in a deposit account or buying a CD, things like that. So we think at the end of the day, these will be treated more and more like traditional assets. Things will be much more transparent. But for people like us who are active in all these markets and are looking to impress our clients every day and earn return on their assets, the important thing is just being able to transparently see what you'll return, what you'll earn on an asset, and be able to represent that back to your clients.
So I think both of you touched on this a little bit, but just looking forward, what do you guys think, and this is for everybody, what do you guys think is the most important development that will help improve liquidity and make conversions more efficient?
I can go. I think we need to go back to the marketplace idea. I tend to think we're in a moment where we are demand constrained, meaning I really think that from a liquidity provider standpoint, the liquidity providers have a lot of options. I tend to think, as Scott mentioned earlier, there's been a lot of innovation and growth in the avenues that liquidity providers have and choices that they have. I tend to think that liquidity will follow demand at this point. What really is holding the entire crypto ecosystem, centralized and decentralized, back is simply retail flow. We need more applications that enable people to onboard in this world through tokens and applications and delightful user experiences to then basically create this demand pressure that it's obviously my guess, but I tend to think that at this point we are demand constrained, meaning that the liquidity suppliers are just ready to go given an interesting, consistent retail flow from a trader perspective. We are not at a stage where basically we can provide models like Robinhood, where market makers are paying to access that consistent retail flow. And that's really what I think this space needs at this point. Liquidity providers are ready to go and ready to embark on the investments that are needed to start providing liquidity on crypto. But what we need is basically more users and more people trading.
Phil, I would add to that a little bit. In addition to the more people, I think that having been in FX for years before running a hedge fund and having familiarity with payments and decentralized finance, I think what surprises me is how decentralized and fragmented the whole payments segment is. I don't know how many billions of dollars a year people earn by processing payments and charging fees, but it's just still an incredibly decentralized ecosystem. I think for DEXs like Stellar and others that are looking to automate that, improve it, reduce the cost, there's just so many hops along the chain and things take so long to allow the person in the United States that wants to send pesos back to their family in Mexico, whether it's $50 a week or $500 a week, to be able to give them an ability to do that in real time and not pay a 5% fee is very, very challenging. There are lots of hops and lots of pieces that you have to pull together. So putting the liquidity in the middle via the DEX is great, but there are just a lot of other pieces of the puzzle that have to be connected. And then on top of that, you have all sorts of other issues involving credit and settling and things like that. So I think it's an incredibly fragmented problem to solve. We do think it'll start getting solved more easily next year. And we think improving the credit within the ecosystem will help solve that problem as well.
Hey,
Catherine, do you have anything?
Yeah, Scott, you bring up a great point, and I think we take for granted often in the crypto space the complexities that the rest of the world has been running on. Scott and I come from an FX background, and that's fine and dandy because we've been focused on purely making trades in very effective markets through electronic trading or through voice brokers, and we really rarely touched the backside like flow of getting those funds in, the credit management, the risk management systems that were all occurring inside of the banks already. And so same with payments, you break down, okay, well, I've got a Visa connection. Well, it's actually, you've got a payment processor, you've got a card acquirer, you've got all of these, rather than decentralized, siloed businesses that have been thriving on the fact that they are critical to a complete life cycle of a payment. So that's something that's just in crypto, while we want to be solving things for the individual with super amounts of ease, we're not decentralizing or democratizing one variation of it. We're affecting multiple business types that are in there, and they were built in different ways because they're so complex. So I think that's something that we just oftentimes have to remind ourselves in the crypto space is okay, you can solve the liquidity issue. That's that's one step, but can you solve the end payment or the processing out to the consumer? Someone in Mexico might not want to be receiving digital assets. They might want to be receiving cash in hand, not even through a card in means, because the shops or the payments that they're having to provide need to be cash. So it's really that cycle of understanding how we're getting it into the hands of the users in the means that they would prefer it, and how we can change that narrative so that people are preferring more digital means of payments, and having those waters meet will really be kind of what helps us be successful. I think we're seeing a little bit of that come in with payroll, which is an interesting thing, and having folks now kind of turning their heads and going, both from a corporate treasury perspective as well as an employee perspective, could I be paid in Bitcoin? Could I be paid in crypto? I prefer to be paid in crypto or Bitcoin because, here I've got a card that can also let me spend it. And so we're getting some of those puzzle pieces that will help us solve the full cycle of what we need. But at each step of that, you're going to need competency as well as a quality product that delivers what we need it to do in crypto. And that's often difficult because we're still so new as an industry.
Great. I think we're up on time. I might be able to take one. I apologize to the questions that were asked. I will try to get back to each of these questions after the conference. But yeah, I think we're up on time. I just want to thank each of you guys for joining me on this panel and providing all your great insights. And enjoy the rest of your pre-Friday, everybody.
Excellent. Thanks, Phil.
Thank you so much.
Yeah, Catherine, I'll talk to you guys.
Yeah, Scott, I'd love to catch up again.
Right,
same with you all. Bye-bye.
Bye.
All right. Well, thank you so much, Phil, and the rest of our panelists for that really interesting discussion. Liquidity is a key piece of facilitating things like cross-border payments. And it's really exciting to me to see such smart and capable individuals really thinking about how to tackle that problem. Well, we would love to hear your feedback on the session as well.